Are you a business owner who struggles to manage your cash flow effectively? Do you wonder why your business shows it's profitable, but you have little to no cash in the bank? Recently, I recorded an episode on the effects of poor cash flow and some tips to help improve it. Today, I'm going to expand on the topic a bit more and explain the difference between cash flow and profit, improving your cash flow in the business, and how to forecast your cash flow over time. Tune in to learn more.
Welcome to Biz Help for You, the show that saves you the expensive learning curve by providing advice from industry experts in every facet of the entrepreneurial journey. Too many small businesses collapse. According to the U.S. Census Bureau, 20% fail within their first year, and less than 35% make it to their 10th anniversary. The goal of this podcast is to change that statistic. So if you're interested in learning more to be a successful entrepreneur, tune in today.
Welcome back to another episode of Biz Help for You, where we bring you the best tips and strategies to help your business thrive. Today, I'm diving into a critical topic, managing cash flow, which is the lifeblood of every business. While the rewards of your work may come in many forms, if the cash coming in doesn't exceed the cash going out, you could quickly find yourself in trouble. Before I discuss how to improve cash flow, I want to explain something that often causes some misunderstanding of a business's financial health. Many people get confused regarding the variances between cash flow and profit. I want to encourage you to download my free guide to financial lingo, which gives more examples to help demonstrate the differences. You can access it at bit.ly/finlingo. That's fin with a capital F and lingo with a capital L. So bit.ly/finlingo. I'll include the link in the show notes as well. But for now, let me give a quick summary to explain what each is. Profit is what is left over after you earn your income and pay your expenses. Cash flow, on the other hand, is the movement of money in and out of your business. So profit is looking at the products you sell, the cost of goods for making those products, and your overhead and expenses. And the leftover amount is your profit. Cash flow could have money coming in from loans, accounts receivable, or sales, and your payments could be reducing liabilities, purchasing fixed assets, or other expenses. So as you can see, cash flow and profit are two totally different things, yet they do work together. When you're struggling with cash flow, there are a few things you can do to make improvements. You can collect funds faster or pay your bills more slowly. To hear all of my recommendations, tune into my episode titled Managing Cash Flow Effectively. A link is in the show notes. But let's do a quick review of some things that can be done. Invoice immediately. Entrepreneurs are often so busy doing the work for their clients that they forget to set time aside to invoice for the projects they have done. If you delay invoicing your clients, they might think they can delay their payments to you since it wasn't important enough for you to send an invoice in a timely manner. But most of the time when invoices are finally sent, it's because you are in a cash crunch and need the money right away. Be sure to put your invoicing on your work calendar. Whether it's weekly, monthly, or after the project finishes, be sure to set time aside to prepare the invoices on a set schedule. Better yet, get full payment, or at least a deposit, before work begins. Use electronic billing. This method is fast, and customers are more likely to respond quickly when they can pay instantly. Bookkeeping programs allow you to email invoices and connect payment methods such as credit card processing or ACH payments, allowing for direct deposits into your account and saving time and expenses compared to printing and mailing invoices to your customers. Get it in writing. Set clear payment terms and expectations in your initial customer agreements. Spell out your terms on every invoice. Doing so prevents confusion on when payments must be made to you. Include a specific due date. Due upon receipt can be ambiguous. You may assume they will be on the same page as you and send a check the day the invoice is received. But if they've ordered products which aren't yet delivered to them, they may think it means due upon receipt of the order. Instead, specify the exact terms. For instance, payment due within 30 days of the bill date, to clearly communicate your expectations. Institute late fees. Without late fees, customers might delay payment until it's convenient for them, not for you. Set a fixed fee or percentage of the total if payment isn't received by the due date. Offer positive incentives for early payment. On the opposite side of the spectrum, instead of penalizing someone for a late payment, incentivize them for paying early. Give customers a reason to pay sooner, such as a set discount or a percentage off the total for payments received within a specified number of days before the due date. For instance, 2% net 10 means if they pay within 10 days of receiving the invoice, they can reduce the amount by 2%. If you had given 30 days terms, you would get payment 3 weeks earlier. Factoring invoices. If you need immediate payment, consider selling your invoices to a factoring company. For a small fee, they'll pay a significant portion of your original invoice amount up front. When the customer pays, you'll be paid the remaining balance. Now that we have looked at some ways you can speed up getting cash in your business, let's look at how you might be able to hold onto cash a bit longer as well. Slow down on bills. Hold off on paying bills until they're due. Set your target for a day or two before the due date to ensure timely arrival and avoid late fees. If you pay electronically, you can schedule payments in advance to be paid on the due date. If there's no incentive to pay early, such as the early pay discount I discussed just a minute ago that you could offer to your own clients, there's no benefit for you to do so. Holding your cash the extra days will give you access to the funds for longer. Periodic payments. Take advantage of periodic payment programs that are fee-free. For instance, with workers' compensation coverage, you can pay premiums based on actual payroll every time your payroll is run, eliminating the need for a large down payment. This takes a little more time to submit your wage information each time payroll is run, but being able to pay less over a longer period of time can be a great benefit. Let's now review what you can do to plan for the ups and downs in your company. Monitor your cash flow weekly. Regularly check what's been paid, what's coming due, and what's late, whether it is owed to you or you have outstanding bills for vendors. Set a schedule to follow up with past due clients. Just as I recommend putting invoicing on your calendar, be sure to set time aside to follow up with customers to give a gentle reminder regarding the past due balances. Review your current bank balance and account for the inflows and outflows to make sure you'll have enough to meet your requirements. Create a cash flow forecast. Create multiple scenarios so that you can adjust as necessary throughout the year. For instance, in most cases, you generally want to have a best case, worst case, and realistic scenario. Look at your trends and adjust as necessary based on what's happening in the current period, as well as what has happened over the last 9 to 10 months to help you refine your sales figures as necessary. As you go through the days, weeks, and months of the year, you can continue to alter information to get a better understanding of what is happening. I usually recommend having your cash flow plan on a weekly view for a full quarter at a glance to help you plan when funds come in and when you pay out expenses. This can help identify any weeks where cash dips less than the amount you want to have available at any time. Creating a cash flow forecast is helpful for managing the financial health of your business. Here's a step-by-step guide to help you create an effective cash flow forecast. Step 1. Gather financial information. Start by collecting all the financial data you'll need, including historical sales data, expense records, upcoming financial commitments such as rent, salaries, loan payments, and other regular ongoing expenses. Step 2. Choose a forecast period. Decide the time frame for your forecast. Monthly forecasts are common for small businesses, but you can also create weekly or quarterly forecasts depending on your needs. Step 3. Estimate cash inflows. List all expected sources of cash during the forecast period. Common cash inflows include sales revenue, accounts receivable collected, infusions of cash through loans or other financing, interest, and investment income. Use historical data and any planned sales or marketing initiatives to estimate these amounts as accurately as possible. Step 4. Estimate cash outflows. List all expected cash outflows during the forecast period. Typical cash outflows include operating expenses such as rent, utilities, wages, and insurance, cost of goods sold, loan payments, taxes, capital expenditures, and miscellaneous expenses. Be sure to include both fixed and variable expenses. Again, historical data can help in making these estimates. Step 5. Calculate net cash flow. For each period, subtract the total cash outflows from the total cash inflows. This gives you the net cash flow for the period. Net cash flow is, again, total cash inflows minus total cash outflows. Step 6. Prepare the cash flow statement. Organize the information in a cash flow statement. Traditional reports have 3 sections: operating activities, which is cash from sales, payments to suppliers, and operating expenses; investing activities, purchase of equipment or investments, and proceeds from the sale of assets; and financing activities, loan proceeds, loan repayments, or equity injections. This detail may be more than you need. The main thing is to know if cash flow of the period is positive or negative and your remaining cash balance. So feel free to simplify it to combine money in and money out and net cash flow for the period you're tracking. Add the net cash to the beginning cash on hand balance to determine the amount you expect to have at month end. Step 7. Monitor and adjust. Regularly compare your forecast with actual cash flow. Identify any variances and adjust your forecast as needed. This ongoing process helps improve the accuracy of future forecasts. Step 8. Use cash flow forecasting tools. Consider using cash flow forecasting software or spreadsheets designed for this purpose. Tools like Excel, QuickBooks, and other accounting software can help streamline the process and provide more accurate forecasts. So here are some tips for accurate forecasting. Be realistic. Use conservative estimates to avoid overestimating inflows and underestimating outflows. Update regularly. Keep your forecast up to date with any changes in your business operations. Plan for contingencies. Include a buffer for unexpected expenses or shortfalls in cash inflows. And consult professionals. If you're unsure, consider consulting with a bookkeeper or accountant to ensure accuracy. Creating a cash flow forecast helps you anticipate potential cash shortages and surpluses, enabling you to make informed financial decisions and maintain a healthy cash flow for your business. If you are unable to effectively forecast your cash flow because you struggle to keep your bookkeeping up to date, we can help. Reach out to us so we can learn about your business and the challenges you are facing. We can cater our services to meet your specific needs. We can be reached at 310-534-5577 or contact@abandp.com. The main thing to remember is that if you are monitoring your cash flow weekly and revising your projections as needed, you will have a better handle on your finances and not be taken by surprise finding yourself in a pinch. Whether you use a piece of paper, a spreadsheet, or accounting software, keeping track of your information will help you stay on track when it comes to your finances. Thank you for tuning in today. Would you please share this episode with those you know and leave a review on your favorite platform? And if you find our show informative, would you consider being a financial sponsor to help me continue my mission to educate business owners? A link is located in the episode description, and no amount is too small. I'd really appreciate your support. If you are interested in connecting with our guest and receiving the offer they had to share, A link to our resource page is in the show notes. Finally, if you have any bookkeeping or payroll needs, reach out to us at 310-534-5577 or contact@abandp.com. My team and I are eager to assist you. Until next time, have a great day.
Thank you for listening to Biz Help for You. Please join your host, Candy Messer, again next time. Have a terrific day.